Hello. Hi. Hi, everyone. Thanks for joining us, this panel. Thanks, Steve. Thanks, Wholesale Investor. It's always good to come and speak to your audiences. Today, the topic, as was talked about, is sort of venture investment theme, but we're going to go a bit broader. We're going to actually talk about some macro thematics too that do impact what happens in venture capital. We're going to cover markets, both public and private. We're going to talk about, like I said, investment themes. We will also talk about growing need for liquidity, which is sort of on everyone's mind right now. And I have an absolutely fantastic panel with me here today, covering right from early stage to sort of growth equity to late stage and pre-IPO and crossover as well. So we're literally covering the entire spectrum. Let's do some quick intros first. Why don't I start with Isabella? Can you just introduce yourself and your funds?
Sure. How do I?
Are these mics on?
Hello. Oh, it's now on. Thank you. Hi, everyone. Great to be here, and thanks for coming. My name's Isabella Rich, and I'm an investor at OIF Ventures. We are a venture capital fund based out of Australia that invests primarily in Australian and New Zealand technology, range from seed, Series A, and have just raised a growth fund, and have approximately 40 portfolio companies across the funds, all kind of technology.
Hi, I'm Karen Chan. I'm with Perennial Private Investments. We're part of the Perennial Partners umbrella of funds. We run a multiple funds mainly focused on the growth stage through to pre-IPO, so I'd say starting from Series B. And we also are a crossover investor, and part of our mandate is to invest in IPOs as well as selected listed placements. We've made over 90 investments and have also achieved a liquidity event for about a third of them, and really pleased to be here today.
Hello, everyone. My name is Rajiv Gupta. Firstly, thank you to Steve and Wholesale Investor for hosting this event. I'm from Allium Capital, which is a 7-year-old fund. We do public and private investments, 70% in the private space, largely technology focused, like my peers on the stage. One of our key outcomes is to get companies to list on stock markets, and we've had success in the UK, Australia, as well as Canada and the USA.
And as was mentioned, my name is Amit Verma. I'm with the ASX New Listings, New IPO team. We work very closely with companies across technology, healthcare, and their investors as well, educating them on the sort of public markets and helping them list when the time is right and for relevant companies. Outside of that, I'm also with the A3 Investment Syndicate with A3 Explorers, and I'm also a mentor. I also mentor companies at the Founder Institute. So, and I think many of us also look at companies, investing into companies at an angel stage. So we do cover the whole spectrum. So let me just set the scene a bit for you all. So like I said before, we're going to talk about sort of investment themes, venture themes, but we're also going to talk about the connectedness of the venture capital ecosystem with the overall capital funding continuum. Venture doesn't exist in isolation. You know, what happens in public does affect early stage as well. So we're going to just explore that a bit. We'll also talk about, like I said, the need for liquidity, the growing importance of that, the ability to recycle capital into new deals, talk about areas of focus for these great folks here. And I would finally love audience questions as well. So probably when there's about, I don't know, between 5 and 10 minutes left, I'm going to turn to you all. So please have some questions ready. We always like audience questions. Sometimes the best conversations happen when the audience questions start. Right, so let's first talk macro. I'm going to start with you, Karen. You know, we're seeing positive signs coming from the US. A lot of talk about interest rates peaking, inflation potentially on the way down. The markets, you know, NASDAQ 100, S&P 500, ASX 200, etc. They're kind of close to their all-time highs, notwithstanding daily, weekly fluctuations. That happens all the time, but overall the markets are high. And we know that there's a bit of a lag that takes time. It takes time for that market environment to translate into activity in the private markets and new IPOs. So Karen, starting with you, what are you seeing out there? Are you thinking that we're turning a corner soon? What are you seeing out there with deals?
So I think right now, I think investor and consumer confidence is actually really important in terms of the psyche of whether we should be investing or not. And we really have started to reach a corner in the sense that we're starting to see rates moderate. We've also started the year out where we actually expected the indices to actually fall over the course of the year, but we actually haven't seen that at all. So just domestically looking at the ASX or ordinaries as well as ASX 200, that's up roughly around 6% year to date. And even in the last month, it's up around 1.5%. And from a deal flow perspective, it's been a real drought. We haven't seen much pre-IPO activity and hardly any IPOs. And so we saw Redox list recently, and it's actually now, I think, just above the issue price. So now it's like a $400 million IPO. So that's a sizable deal. So there has been good institutional take-up. And from our listed desk, we've seen in the last couple of weeks at least 5 non-deal roadshows. So we think that the macro environment has now sort of reached a turning point, and we're starting to see more deal flow. And I think this is really important because if you start seeing an unblocking of the liquidity pathway on the listed exchanges, then I think you're going to see that flow through to the private markets.
Rajiv and Isabella, I'd like you all to touch on the same topic because you'll look at different stages of the market and you might have different nuances and different experiences. Maybe Isabella, I might start with you.
Yeah, no, it's a really interesting market, and one that we feel, I mean, if you look at the last 10 years as a base, you had a kind of normalized range of valuations and number of companies coming through all the way probably to 2021. And at 2021, you had a huge wave of capital that was deployed into the venture ecosystem at extremely high valuations. And what you see today is probably a normalization of that, which we see as a good thing, in that founders, we're seeing very high quality founders who have an understanding of how to build a software business because they've been at the Atlassians, the Canvas, the Go1s of the world. They're thinking about unit economics from day one, and the valuations are kind of on a median level in terms of the last 10 years.
Inflation will be sticky. It may go higher, but not much higher. Rates globally in most countries and economies are up 4 or 5% off the zero base, and most people have had 8 to 12 increases. We're not going to get 8 to 12 decreases in the next 2 years. We'll be lucky to get 1 to 2, so get used to higher rates, but they're still only between 4 and 6% globally, generally speaking, so it's not that high, especially for those of you that remember, and I remember I was at uni, it was 18% way back then. When it comes to making money investing in companies, you'll make a lot more investing in companies than you will leaving your money in the bank. So this period that we've had in the last 12 to 18 months is an adjustment period. If you look at public markets, they led the market down. So they started to retreat in late 2021, and it was a hard period for equity investors all of last year. Private markets lagged that. And what we're seeing now is that here on the ASX, in some stocks that were hot 2 years ago and fell by 80, 90%, some of these things are up 100, 150% only in the last month. So in our opinion, small cap technology companies and equity markets will likely lead a recovery for private investors, but it will be with a lag of probably 6 to 12 months as it was on the downside.
You mentioned valuations, Isabella. Let's probably stick with that thematic. And not just valuation, but the overall fundraising environment for tech companies, for startups. Many of the founders who are here today might be interested in knowing two things primarily. How much money is available in the market for them? Because, of course, deals are taking longer or were taking longer. Some folks, some VC funds are fundraising right now. Some have raised large rounds last year. So how does that translate into that actual fundraising environment for them? What does it mean for them?
Yeah, so I mean, picking up on your point, from a venture capital perspective, we raised a fund last year off the back of distributing capital to our existing investors, and that's enabled us to continue to deploy over the next couple of years, which I think will be one of the best couple of years we've had to invest in early stage technology companies in Australia. in terms of from the founder's perspective, I would say that you only have to look around, to see the amount of dry powder there is in the Australian ecosystem. I think what you see is that there's a number of venture capital funds that have capital to deploy. They'll be deploying it more slowly than what we've seen over the last couple of years. What has kind of dissolved to some extent is the high net worth investor capital into kind of very early stage, high risk companies. And so you're seeing kind of that being made up by a number of pre-seed funds that have come into the market. But overall, you're exactly right. It's taking longer, and the requirement of getting towards profitability with the capital that is going into the company is far greater than we've seen over the last couple of years.
I'd also like to add that I think founders need to also think of value creation as a long-term journey. So you might feel like you're raising at a lower valuation than you would like, but at the end of the day, it is about survival and being able to continue to grow the company. So we think that just also when a company is looking to list, that's actually the start of the listing journey, and there's many opportunities to create that value over the long term.
Just sticking with that valuations theme, I've had a bunch of folks, talk to me across both the listed side, but also in the private space, asking questions like, we want to raise, but we're holding back because maybe we're not going to get what we want. So in your views, what's coming down the line for them? Of course, we don't want valuations to go to crazy levels like 2021, but do you think there's, taking the cue from public, whenever it turns, what do you think is going to happen in the next 12 months with private valuations? 12 to 18 months, let's say that.
They've already started to come down, but they've come down slower than public did. In our view, they'll continue to go down probably another 40 to 50%, because most of these companies were valued on metrics that just made no sense. Does everyone in this room, I'm assuming everyone's heard of this metric, the people talk about TAM, which is, it stands for total addressable market. Every company that we meet in private land that wants to raise capital has a ridiculous addressable market. They'll dominate the world. We've changed our tune. So for us, TAM stands for totally absurd metrics. Ultimately, business is about revenue generation and how you show profit. For the last 5 years, in an environment of zero rates and flush with liquidity, you can tell any story you want. You can say that you're growing from nothing to 1,000%, people believe you, and you raise money. It is not about that anymore. It's about fundamentally building a good business with a good product that generates good revenue and retention. So I think that is a narrative that has changed, albeit slowly, but I think it accelerates.
Karen, Isabella, any views on that?
I think it's a great time to be investing. I think, as Isabella touched upon, I think whether valuations will keep coming down, I'll be on the sidelines on that. I think it really depends on when a company last raised and what valuation that they raised at. So I think some companies would have had crazy valuations. We've got companies in our portfolio that, for example, raised during COVID in a sector that was out of favour, but have actually proved out very strong growth on the top line and also profitable now. So we think that if they were to go out today, they would get a much higher valuation than which they had previously raised at. So I think for all of us as investors, we need to look at each company case by case, and I think it's a good time to be investing.
Is there anything?
I would just say that, if there's a hesitancy around kind of different valuations or raising an valuation that was less than your last price, but I would say to founders, look at the amount of dilution that you're taking from any potential investment, and does that return on capital exceed the amount of value that you're going to accrue in the future? And if the answer is yes, then you'll end up with a more valuable stake in your business going forward. So that's typically how I look at it.
I'm going to turn the conversation to liquidity now, but after that, I'm going to turn to the audience when we hit the 10-minute left mark. I've got a few more questions, but I'd love you guys to jump in as well. So let's talk about liquidity, as I mentioned earlier. I know a number of VC funds have already hit their 10-year marks, already started, doing continuation vehicles or getting extensions. Early stage investors want liquidity now. Early stage founders and early employees want liquidity. And Karen mentioned that on the ASX we did Redox a couple of weeks ago. Yesterday we had another really big, day before yesterday, another big one, Abacus Storage King. It was a $1.8 billion listing with about $225 million raise. So that was very good. And we've got a strong pipeline for the rest of the year. Mind you, for traditional, largish, profitable companies though, I think the non-profitable tech stuff will probably come next year. But for the rest of this year, we do have a strong pipeline of profitable businesses. I'm going to start with Rajiv. How do you think this need for liquidity is going to play out over the next sort of 12 to 18 months? Connecting both public and private. Because it's like I said, it's all linked, right? What happens in public and then flows down. So how do you think it's going to play out?
There's been a ton of activity even on the stock exchange. It was, you will know better than me, but $14 billion was taken off through strategic sales. I think that will accelerate. As that accelerates, there will be a need for more and more companies to become listed assets. So I think liquidity for many of our portfolio companies, we are encouraging them to go public at the right time because we're focused on technology. And to Amit's point, you need it to be profitable, generally speaking, in tech. We think next year will be really strong. Corporate and strategic sales will continue to be an important part of liquidity for investors. In addition, there's a ton of secondary that is out there, and you've got to selectively look at them, and you can have price negotiating power in some of those transactions. So I think there will be plenty of liquidity. We're strongly of the view you never want to own an asset forever. We're impatient investors. We want returns.
Can I just add that investors actually are now focused more on distributions rather than just a paper gain. And so I'm sure, Isabella, you can touch on this because I think OIF is one of the few VCs that have actually returned a lot of capital to their earlier investors. Like Allium, we're also focused on returning capital to our investors. So that's a big focus. And so we think that there might also be more secondaries because a lot of the funds are looking to return that capital. So there could be opportunities, and that is an area where you might be able to get some discounted opportunities.
Yeah, I would just add our first fund was a 2016 fund. We sat down as a team in the early stages of 2021 and said, how, what does the portfolio look like, and what do we believe the next couple of years have looked like? And for us to be able to raise a third fund, it was important that we distributed capital from early funds. So we distributed 3x back to investors to then continue to ask them to entrust their money with us. So I think it's really important, and I would just echo Rajiv's and Karen's point where there's, we said there's to be 3 types of opportunities to exit, and all of which, or 2 of which don't actually impact the founder materially. The first is secondaries, which, there's a number of funds that come in on top of us and invest in that later stage. So we exit through that in that respect. Secondly, there's kind of strategic exits. And then thirdly, there's the IPO channel, which we've looked at on a number of opportunities together.
Thanks, Isabella. And talking about that IPO channel, yes, we can't control the market. So right now, what we've been doing is, focusing on building the pipeline for later this year and next year. So if there are any founders or investors in the room that want to talk more about the public markets, please come and hit me up on LinkedIn or catch me later outside. Happy to have a chat, yeah. Right, we've hit the 10-minute mark. As promised, I'm going to open up the questions to the floor, and I would love to see a few hands. Perfect. Off you go. The question was, what are the common characteristics of the management team, particularly in the CFOs of the companies you've invested in? Who wants to take first?
I think in general, we want to have CFOs that we can get information and good information from, being able to clearly articulate what are the growth and drivers of the business. At the end of the day, it's like a relationship. So from our perspective, we're minority investors. So we really do rely on the management team. So we do want a management team that we can trust.
So 2 comments. In terms of founder and CEO, we generally want the person to be very technical as opposed to marketing orientated. Red flag for us is someone who's very strong at marketing and weak at technical. And it's no different on the CFO. You want them to be a chartered accountant, generally speaking, not someone that's done an arts degree and knows how to use an Excel sheet. In addition, we look for CFOs that are strong at managing capital and can be involved in the capital raising strategy, not relying just on the CEO and founder.
So a few hands go up. Who is...
Yes, I just had a question about accounting. So you mentioned before that sometimes people tend to be over the top about how deep the well is. If you were to complement that in a business plan with SAM and SOM, the service called the capital market and the adjustable markets, would that be a reasonable approach? Like say the TAM is like, okay, avatar specific, this is how deep the well could potentially be growing. But this is, with our resources, how much we could actually tap into that way. Would that be more of a reasonable approach, or should you feel much push the board back?
No, I was being facetious. It's always good to have TAM, SAM, SOM, but you're not going to dominate 100% of TAM. So you are dead right in SOM, and for those that are not familiar, TAM is addressable, SAM is serviceable, and
SOM is obtainable.
Obtainable. Yeah. We don't rely on any of those, but they do exist out there. But I think you're dead right. If you can get to SOM, absolutely. So you should show it. What it does reflect is you've got to understand the market you're playing in. And that's what it does do. So don't leave it out. Just don't rely on it.
We've just seen founders in the past just throw out a massive, like, billion-dollar number, but haven't really sort of engaged or thought about the TAM. So I think that's what you were trying to get at, Rajiv, right? Whether you've actually really thought about what is the actual market and is it big enough for you to actually take share in?
One thing on that I find really useful when founders, what founders do is there's a market that you can go after, and then there's the ability to sell products into that market, and the unit economics behind how you go to market then dictates A, the amount of capital that you'll need to access that, and B, how quickly you can do that. So, the way I think is really important to showcase, as well as the total market.
You raise a good point, though, because we've all looked at thousands of pitch decks, and to Rajiv's point, I hadn't heard of that acronym before, but I might steal it as well. I love it. We do see some absolutely crazy numbers thrown about, and investors often don't take a couple of slides seriously in your deck. One is that TAM one, because it's just everyone's always got a $5 trillion TAM. The other one is your revenue projections, which are always top to the right? I've never seen a revenue projection like that. It's always like this, irrespective. So I think investors want to see you, they want to hear about what your views on the TAM, SAM, SOM, but they also want you to have a very close understanding and relationship with your pipeline. That's more important. What are the sales you're going to close in the next 60 days, 90 days, 120 days? A deep, intimate understanding of that customer pipeline, as opposed to we're going to have 6 times our revenue this time next year, which sounds not realistic.
And I would add to that in saying that there's probably a number of companies, could fit in one hand, where they've come to us and said, here is the deck that we presented to investors 2 years ago, and this is what we've either broadly hit the targets or exceeded them. And for that, that from an early stage perspective is very rare, and gives investors such confidence that you can execute, to the CFO's point, you can execute on the projections that you put forward.
Can I just also add an additional comment? A lot of companies grow at triple-digit rates for 3 years into the future. To Isabella's point, unrealistic. It's okay for a business to grow at 30% per annum, which is 5 to 6 times the GDP rate. But again, it comes down to, at that growth rate, how profitable can you be? A company that generates a net margin of 5% versus a company like Microsoft that does 36%, they should trade at different multiples. So for people to say, well, our multiple is 6 times EV to sales, it's almost irrelevant.
Yes.
My first question is, what would be the considerations of you co-investing with a principal out of Southeast Asia?
What would be the considerations for investing with a principal out of Southeast Asia?
I think co-investments. So I think all of us here are not buyout type investors where we want to take the whole round. So we are very much open to co-investing, and we have co-invested with actually many funds as well as many family offices, some of which are offshore. So I think it really comes down to what the investor adds to the cap table other than capital, which I think right now is really important. But that connection and value add is an important consideration for the existing shareholders. Yes, so we do definitely invest across the cap stack. Convertible notes is one of the structures that has become more popular in bridging to the next round. If it's a pre-IPO round, it typically is a convertible note structure because it then holds the company to a timeline. So the pre-IPOs have not been as popular more recently, but we have seen a few more of those rounds actually starting to pop up more recently.
And in the early stage space, of course, convertible notes are popular, but also the other instrument, the safe notes, which are quite popular with the very, very early stage where pricing is just so hard to do.
I think, I mean, my only point on that is that I think a lot of founders come to us with to say we want to raise on a convertible note on a safe so that we don't have to value the company today in an environment which is, depressed in terms of where it was 2 years ago. But I would caution founders on that because if you don't execute perfectly, in a lot of instances, the dilution that comes off the back of that is actually far greater than kind of going out and raising at a priced round.
And then finally, on those two instruments, even though it's unpriced, most investors wouldn't invest unless there is a valuation cap. So there is an indication of sort of pricing anyways, yeah. Yeah.
Do you have any views on CSF, crowdsourced?
Could you just repeat that a bit louder?
Do you have any views on crowdsourced equity?
Crowdsource. Who wants to go?
I think crowdsourcing is a great method actually for those companies, particularly say in the consumer space where they have a broad, retail customer base who can actually be part of the journey. I think the one thing to consider is actually whether it is more than one party on a cap table, because if you end up having thousands of people on your cap table, it can be unwieldy to manage.
Yeah, I concur. Consumer companies, we've had 3 that have done it. It's been successful. Just don't do it too early, and I wouldn't do it in the first round.
Is there anything to add? No? Cool. All right. We have exactly 1 minute left, so I think time for one question. Whoever raises the hand highest. There you go.
Hi, Leo from Spruce. It's great to see the different stages of fundraising. I got a question. What is your biggest single red flag in the current market? Like when you look at potentially people pitching to you, and at the same time, and if I can answer for each very short, and at the same time, what's the magical word? And don't mind if I take notes on that. So.
Biggest red flag and magical word.
So biggest red flag for us would be they come in, make a presentation, you ask them to send you things, such as the financial model in more detail, or the customer list or contracts if they've got a data room, and they take weeks to respond. So they've been preparing it for you, which means they were ill prepared when they came in. So that's the red flag. The magical word for us is liquidity.
Say lack of track record, but then promising the world. That's more than one word. And then magical word is profitability.
For us, we invest very early, and it's where there's kind of no product in market or kind of a couple of $100,000 of revenue, and a founder is paying themselves $750,000 and raising $1 million. So, like, majority of the capital is going to go into 1 year's salary. And magical word for us is an awesome team. We're minority investors who kind of take an active role that we want to work with for the next 10 years.
I'm just going to flip it around. So, red flag from investors to you guys. So if you hear an investor saying, "Who else is in the round?" just be careful. And magical word from an investor to you all should be, "I'm going to give you all some money, but I'm going to help you with sales as well." That's really good, yeah? All right, please join me in thanking this fantastic audience. Thanks for your questions. Really loved it. And come and grab us outside if you want to have a chat. Cheers all.